Even when using realistic, historically based, very conservative estimations for Meta's future, I'm easily coming up with a greater than 200% upside. And that's even if the metaverse doesn't pan out. I hope you'll tell me what I'm missing, because I've got to be missing something. Let's dive in. Welcome back. It's so good to see your smiling faces. My name is Steven Spicer. I'm a certified financial planner, a wealth advisor, and I need your help. That's why there are videos here. They're not here to help you. I need you to make sure that I'm not missing anything big here. Help me avoid big mistakes in my investing life. So yeah, of course, this is not financial advice. I don't know your financial situation. In fact, in this case, I don't even actually own shares of this stock yet, right now, as of this recording. So of course, it's not advice. I'm not recommending you do anything one way or the other. Please read my full list of disclosures and disclaimers at the link in the description. Last time we talked about Meta platforms, its shares were down around 40%. Today, they're down closer to 70%. It was $230 per share, now it's around $115 per share. I want to build off of that video, so if you haven't seen that one yet, you could check it out at the end of this one. That would be just fine. I'll hit you up with a direct link at the end because I'm going to talk about some parts of Meta's strategy there that I won't talk about here. I don't want to double up too much. Now, in that video, I pointed out two primary concerns that investors seemed worried about. The first was the first ever decline in Facebook's daily active users. Well, they have since recovered from that. That number is still somehow going up, despite it being such a large percentage of the population already. So we're good there. I dive into that much more in the last video. It's pretty fascinating, the reach that they have. But the second concern was their metaverse spending. And at this point, we have much more light to shed on that reality for the company. And I'll get to that in a bit. But I also spent time in that video talking about the potential for macroeconomic headwinds, putting pressure on online ad spend. That video came out in February of this year, so just at the beginning of when we started to see those pressures. It seemed obvious to me that unless the Fed or the other powers that be chose to kick the can down the road relatively soon, that these online ad platforms like Meta and Alphabet would suffer. And, well, they have. So perhaps today you could add to the list of investor or potential investor concerns with the company their declining revenue. But for us, we saw that coming, right? So that shouldn't have been too much of a surprise. In fact, I've heard a lot of investors since that time say that they thought that the market would be more resilient than it has proven to be, the online ad market, that is. And that confuses me. It makes sense that marketing budgets would be slashed during times of macroeconomic uncertainty, just like they were during the GFC in '08. I have a client, for example, who is a social media influencer. They had a great recurring sponsorship deal going with a large corporation. They were just getting ready to renew earlier this year their contract for another few months for a six-figure sum. And, well, that company's marketing budget was significantly reduced just before they were supposed to sign their side of the contract. They had to pull out. It makes total sense. I don't know why some experts seem surprised by this, but it doesn't matter. You just need to be prepared for the volatility in what Meta's stock price might do as a result of either, one, a rapid recovery, perhaps because central banks revive their monetary easing schemes, or two, additional pain as the economy sinks further into recession and more businesses have to cut back, leading to even more revenue declines for ad platforms like Meta's. So you and I are at least ready for either of those scenarios. In the last video, we also explored the iOS changes that were hurting Meta's revenue, as well as the increasing competition. In fact, their most recent earnings call really helped drive home the fact that of all their investments, this is the area where they're spending the most, to try to make up for those iOS headwinds and to better compete with competitors like TikTok. Here's what they said in that call.
We continue to direct the majority of our investments towards the development and operation of our family of apps. In Q3, family of apps expenses were $18.1 billion, representing 82% of our overall expenses. We are significantly expanding our AI capacity. These investments are driving substantially all of our capital expenditure growth in 2023.
So the vast majority of their spending is going towards their AI infrastructure and their core family of apps, both on the R&D side and on the CapEx side, versus the metaverse. And they seem to be having some early signs of success in those areas. Things that I, as an investor or potential investor, would view as future drivers of revenue growth, which is a good thing, the next generation of revenue for the company, so to speak. I detail much of those specifics in an article I wrote for Seeking Alpha. I'll link to it at the top of the description and also in the pinned comment if you're interested in diving even more into the weeds. Hope to see you there. All that's not to say that they aren't spending on the metaverse. They are. And the combination of their spending there with all the other spending we just talked about is being felt. For example, in our last video, I observed that their R&D as a percent of revenue was still the same as it had been historically. That's not the case anymore. Now it's up to about 33% of their revenue instead of the 20% they used to spend. Now, when we do our deep dives within our community, I allow and encourage members to submit video contributions to our conversations, pointing out things they've noticed that they think perhaps others aren't noticing or that they haven't been able to find anywhere else online, for example, and also just asking questions. As we were covering Meta, Matt from Australia brought up an interesting point. Here's what he found and what he asked.
Their income may have been a little overblown in the negative. And what I mean by that is most of the spending for the metaverse, they've categorized as an operating expense, even though this is technically R&D work for future earnings. So should that not have been capitalized and in this way appeared on their balance sheet as an asset? So maybe this big drop in net income could have caused the stock to drop a lot lower than it should have.
And he's right. Their spending on the metaverse probably should be counted as a capital expenditure, but I'm actually glad that they're taking it out of R&D expenses. If they capitalized it instead, then they may just have that asset to write off 4 or 5, 6, or however many years from now if things don't pan out the way that they're hoping. With the way they're accounting for it today, though, investors get to eat that frog up front, which for potential investors on the outside has created a much more significant drawdown in the price of the stock than we would have seen had they not been allowing these expenses to eat into their net margins. I hope that makes sense. In short, I think the way that they're accounting for it, even though they don't have to, according to generally accepted accounting principles, is a good sign. Now, they spend a lot of time reassuring investors that their plan for the medium term, really after 2023, is to get back to those healthy margin levels, reducing their percentage spending on R&D and CapEx. We'll see if they live up to that. If they do, I'm not too worried over the long term. If they don't, and display to us that we can't trust management with things like this, with what they say, that's another issue to weigh into our future investment decisions. But as I pointed out before, they have a really healthy balance sheet and are a cash flow machine, and that provides them with some discretion to invest in things that I may not even fully understand. And that can still be okay. They need to be focused on the short term, the medium term, and the long term, all the terms. And as an innovative company, yeah, maybe I'm not seeing exactly how the long-term profitability play is going to work out for something like the metaverse. Perhaps that's why I'm just a guy interested in how money things work and not a technology innovator. But anyway, that way of viewing things is how Meta has always approached these investments. It's always been about getting people on their platforms first, getting in front of as many people as possible first, and then figuring out how to monetize it later. And to this point, at least, they've been pretty good at it. I view the work they're doing on their AI infrastructure and on monetizing their next generation of ad revenue streams, like what they're doing with WhatsApp and Messenger. I view all that as their medium-term strategies. Those are both at single-digit billion-dollar revenue run rates, for example. Not much compared to the $120 or so billion a year of revenue that the company as a whole generates. But the signs of growth are promising for the next generation of revenue drivers. And for the short term, I think the fact that they're willing to invest in optimizing Reels, for example, even at the expense of cannibalizing their other well-monetized assets like Feed and Stories, is a smart strategy for the short-term viability of their existing revenue streams. Yet it's not too short-sighted, which would be ignoring the trend and doubling down on those older existing assets. Add to all of that the potential variable for a TikTok ban. That would, of course, be an insane boost to Meta's share price and revenue and profitability. And I'm not super worried about the viability of their business model long term. They did take out a little debt over this last quarter, a little, like $10 billion worth, which was probably smart from a business perspective. But as I pointed out in my last video, I really liked the fact that they were taking these risks and making these investments without any long-term debt obligations at all. This debt, so you know, is spread out over the next 40 years, which gives them a lot of flexibility. And like I said, was probably, from a corporate management perspective, the right thing to do. But now it adds another layer to what I, as an investor, potential investor, will need to keep an eye on. If they don't rein in their spending in 2024 or quickly thereafter, and it continues to eat up an equivalent or larger percentage of their revenue, destroying their previously healthy margins, and they start relying more and more on debt in order to facilitate those moves, that's going to certainly detract from their promising narrative. Now, I know everybody loves a good valuation, as we've talked about before here on the channel, but before I show you the numbers that I've come up with to get to that 200% plus upside potential, you have to keep in mind how easy it is to manipulate tables like these. I created these tables for that Seeking Alpha article. So if you want some additional context on these numbers or to dive into them just a little bit more, you should check out that article. But I want to share them with you here because I think you'll find them interesting. And I honestly prefer the conversations with you all here in the comments to over on that platform. They can sometimes be a lot meaner. Now, when I come up with my inputs for the models I construct, and I would advise you to do the same here, I try to think critically about each one of my inputs individually before I plug them all into the model. I don't want to see the model populating the end results as I'm plugging in data. It's too easy, too tempting to want to make little tweaks to those inputs just to make the model fit a price target that you may have in your head already, that I may have in my head already. I suspect that's what analysts fall victim to. I don't know, what do you think? All right, so here's the data that you should keep in mind as we're coming up with the variables we're going to use in my bear, base, and bull case scenarios. This data is pulled from Meta's income statement. I just snagged it directly from Seeking Alpha. And if you don't have an account there, and if you find yourself evaluating stocks a lot, it's one of my go-to resources. Now, I'll put an affiliate link for you in the description. Use it if you want. I was able to work out a pretty nice discount for you if you end up using their premium plan. You just have to use my link in the description. But if you just want a free account, that's fine too. Either way, I hope it helps. But check out how crazy healthy their growth rates have been here. Now, we know that the recent drop-off has, for the most part, been due to macroeconomic concerns, people and businesses scaling back their ad spend. It also came from a roughly $500 million Reels headwind, that cannibalization that I talked about earlier. There was also a massive foreign exchange headwind that if everything was on a constant currency basis, their revenue would have been $1.8 billion higher. So yeah, lots of reasons for that recent decline. But during non-recessionary times, their revenue growth has been outstanding. So with that in mind, I wanted to create a very pessimistic bear case scenario here. So I just looked at what analysts were saying. I took the lowest analyst estimate for what this year's revenue will be at $114 billion. And then I took the average annual growth rate that they're projecting going forward of around 10%. I pulled that out from 2023 and on through the next 7 years for our model here. You should also take note of how healthy Meta's margins are. If you've studied other companies, even other large tech companies, you know that these margins are enviable. And that's what they're currently eating into for their investment initiatives today. And what they say after 2023, they will allow to get back to these enviable levels. Well, for 2022, for all these models, all three of them, I use the net profit margin of 21% because the year is almost over, and that seems to be like a safe, conservative estimation. And then from that point on, I use a different net margin depending on which model we're in. For the bear case, I pull that same 21% margin all the way out. So effectively, they continue spending the way that they have been. Their investments don't seem to pay off the way that they're expecting, and or they don't keep their word to allow that margin to recover. So that's effectively our bear case here. That and just crazy low growth that I can't really imagine, but whatever. And honestly, side note, I wouldn't be surprised if 2023 comes in even lower than 2022 from a margin perspective. By the end of this year, I don't know, maybe 15%. But then I expect it to recover ultimately to a point that's quite a bit beyond this 21%. So I'm thinking of this as an average. You should also note that over the trailing 12 months, Meta has repurchased more than 4% of their shares outstanding. In our bear case scenario, I'm assuming no buybacks whatsoever. Finally, the terminal multiple that I assign in the bear case is one that I wouldn't be surprised to see assigned to an old tech giant who is now only realizing a 10% per year growth in their revenue, and for whom investors and analysts are still generally pretty pessimistic. So as I looked through old tired tech companies and compared them to that profile description, I came up with an 8 terminal price to earnings multiple. Anyway, with that and a 10% discount, we come up with a $70 price target. And as we went through all those variables, correct me if you think I'm wrong, but that felt pretty pessimistic, perhaps even on the verge of unrealistic to the downside. So let's check out then the base case. For that one, I start with the average analyst revenue estimate for the full year 2022 of $116.24 billion. I increased the average annual growth rate from 2023 over the next 7 years, and remember, it's an average over that time, to the lowest historical annual growth rate Meta has ever realized in their history as a public company. Before this year, it was back in 2020 with 22%. That feels conservative to me still, but much more realistic than what analysts are expecting. Again, let me know what I'm missing. I appreciate you. For the net margin, I increased that from 2023 on to 26%, which is the lowest net margin Meta posted between 2016 and last year. I also have their share count reducing by 2% per year. And remember, for context, over the last 12 months, they reduced it by 4%. Before the recent drop, Meta's PE ratio had never dropped below 17, which we explored in more detail in our last video. In fact, it was almost always much higher than that. So for a terminal multiple 7 years from now, for a tech company that is consistently growing at greater than 22% per year and maintaining relatively healthy net margins, I think using 16 is fair. So all that seems conservative to me, but realistic, historically based, and like a safe assumption, What do you think? Let me know in the comments before you see the numbers here. What am I missing with my projections? Okay, thank you. But yeah, so that leaves us with a worth to me value of almost $420, which implies a 265% upside from here. Again, probably missing something. Now for the bull case, I could see the numbers I'm about to go through with you, even if the metaverse never really pans out. At least not to be the monetization behemoth they seem to think it might be in the future. Now, if it does pan out, I think this bull case in maybe, longer than 7 years from now, probably, might look pretty understated. But as you probably know by now, for me, I don't like to project, guess would probably be a better word, at things I can't yet fully wrap my head around. That's why you'll rarely see me in profitless, high-flying tech stocks or hear me pumping some of the things that other financial YouTubers might, some others might, because I like to fully understand my investments inside and out. And if there's a variable I don't understand that ends up being a positive for stock appreciation, well, that's a bonus, a pleasant surprise. All right, so check this out. We're going to start from that same revenue number in 2022. We're going to bump up the average annualized revenue growth over the 7 years after that to Meta's 3-year historical average of 28%. If they keep finding ways to keep monetizing different aspects of their existing platforms with the existing holds that they have on the market, even without the metaverse, and even if TikTok isn't banned, with the projected growth in digital advertising spend over the coming decade, that doesn't sound crazy to me, which, believe it or not, is how I like my bull cases. For the net margin, I put that from 2023 on at a level that is still lower than their 8, 5, or 3-year historical averages, which are all over 30%. Anyway, I put ours here at 28%. I bumped their terminal multiple here up to 22, which would be conservative for a tech company growing at just under 30% revenue per year with relatively healthy margins, and if we're in a bull market again at that time. I kept the buybacks the same, and here's what I came up with. I mean, it's just silly, right? I don't even want to say the numbers here out loud. But again, this is my bull case hypothetical, and I think it's even possible, even with their increased spending, and even if the metaverse never really pans out. Maybe the contingency would be as long as they keep their word and start reducing expenses relative to revenue from 2024 and beyond, and they don't continue to ramp up their debt load. Now, honestly, the conservative investor inside me thinks the bull case and the bear cases here are similarly unlikely. But if we were going to do a probability analysis, as we've done in the past, we could favor the bear case even more, just for an added layer of conservatism. And here's what that gets us. An almost $400 worth to me value today, which represents a more than 200% upside. So help me out here. I am obviously missing something. Please save me. Let me know in the comments what that might be. I hope to see you in our community where we go even deeper. And here's that meta video from February. You should check that out next. I'll see you there. Take care.